Hello, traders. Another quiet day today, eh? Morning, Kay. Morning, Dale.
Morning, lads.
Good morning.
Yeah, what should we talk about today? The weather?
Yeah, nothing happening in the market, so let's talk about
Yeah,
sports.
nothing at all going on in the markets. Absolutely nothing. I don't know. It's one of those days you get through to Thursday and you think, all right, we'll get NFP out of the way and roll into the weekend, and you wake up and you think, what the hell's gone on here? That's markets for you. Lots of news to get into, so we shall get stuck into that first and foremost. Bank of Japan first. We'll kick off there. Let's throw a chart up while we're waiting. Let's throw up dollar yen. There we go. Good old dollar yen. Having fun of games as usual. So BOJ absolutely unchanged. Kuroda continue with easy policy. Too early to take exit steps for now. Oh, hang on. Sorry about that. Shut the old squawk off. Yeah, Bank of Japan's Kuroda saying it's too early to take steps for an exit now. Expect rates to stay at current low or lower levels. As I say, nothing out of the ordinary from the Bank of Japan that I saw. Any little things you picked out of that, Kay? I know you're up for it.
No, not at all, mate. Not at all. He's just he's leaving it to Ueda. He did say on the interview that inflation is nearing the 2%, but not yet reached it on a sustainable basis. So it's all over to Ueda. No, the rest is absolutely everything unchanged, which was the base case. So we had a little jump in the yen pairs at the time of announcement, and then it's just been range trading until early this morning. Yeah, where the yen is weakening just a little bit. It's probably as I said on the update in the room and on Twitter. So it's probably, if there wouldn't have been anything else going on with those local banks in the US, yen would have likely weakened more. But I guess this nervosity around other stuff is holding it back for now. And of course, the upcoming US labor report. But yeah, nothing's changed. So I guess the yen will, in some form or another, remain on the defensive unless global risk falls out of bed. We will see about it.
Yeah. Currently, there's no increase in expectations for anything at the next meeting already. A no change in policy in the probabilities is currently 85% versus a 10 pip hike, the balance at 15%. So we're over there. Sorry?
Yeah, one thing I just would like to add is that the market seems to have given up a little bit right now on the Bank of Japan, because over the course of the, let's say, last 5-6 hours, the Japanese government bond yields have shied away from the 50 BP mark, and we are now trading rather around 40, right?
Yeah.
So that's
I think that's probably bit in part to what we've seen in yields across the board today, which
yeah, as well. But then as well, it looks as if some part of the market has given up on the BOJ until at least when Ueda takes office in about a month. Yeah,
that's what I was just about to say. Actually, I think the eyes of Mordor have come off the Bank of Japan probably until a couple of weeks, until the next BOJ meeting, and everyone will start ramping up, getting out their expectations for what he's going to do. That will be a big meeting because it will be his first meeting, and we'll get to hear properly what he wants to set forth with monetary policy. Is he going to stay the line, or is he going to change things up? So for now, yeah, the main market focus is probably off the BOJ for at least a few weeks, and then we'll get back into it again. And speaking of Ueda, he got the approval in the upper house. So did his honchos, Uchida and Himono, They got approved as well. So all signed, sealed, and delivered for him to take over. Over in the UK, GDP data came out today as well as a flood of other data. Monthly GDP 0.3%. This is for January, so starting the quarter off on the right foot. Beating expectations of 0.1 expected versus minus 0.5 prior. The 3-month rolling GDP, you could call it a sort of a quarterly number, coming in flat, so nothing much to talk about there. But that GDP number, a positive coming into Q1. See if it gets maintained. I think getting 0.3% in a lot of economies will be seen as a win throughout this year, given what's happening with rates and whatnot. Some of the other data not looking overly hot. Industrial production looking softer, manufacturing looking softer, construction not as good as expected on the year, down on the month. So there's still some things in there that aren't all pulling the same way. As we've seen from things like the PMIs, it's been the services side that has done a lot of the heavy pulling, and that's particularly the case for the UK, because manufacturing is only some 12 to 15% of GDP, whereas services makes up the bulk of it. So even though those production numbers aren't that great, it's not the bulk of the economy. CPI in Germany pretty much confirmed as per the flash numbers, 8.7 CPI year on year, 9.3 CPI on the HICP Eurozone number there. Coming across to the Bank of Canada, and this sort of flew a bit under the radar, I think, last night with everything that started kicking off yesterday afternoon, evening. Bank of Canada's Rogers said they are looking for more evidence that current rates are high enough, and reiterates a rate pause depends on economic developments. Stronger US and European outlooks could fuel inflation in Canada, and we're still more worried about the upside risks after the rate pause. Canada will follow its own path in normalising policy, and also that the economy's still in excess demand. That's a bit of a strange line, because that bit of language got taken out of the statement from the BOC earlier this week. Also said the labour market is incredibly tight and staying tight, even as we see the economy slowing a bit. So in my mind, some fairly hawkish comments from Rogers, particularly the first one, looking for more evidence that current rates are high enough, suggesting that there's a possibility of taking them higher. Now, we know the BOC, like every other central bank, are not going to pencil themselves into a corner or fence themselves into a corner by keeping the door open for hikes. But compared to what we had from the statement this week and from others, I would suggest those are a bit hawkish, but not that you'd know it from dollar CAD. What do you make of it, guys? Bit of a hawkish turn?
Well, yeah, perhaps it shows a little bit of divergence in opinion between her and the Stiffers. Yeah, I don't know. There was some of it in the statement, but in the statement it was pretty clear though that they are on hold. Perhaps a bit more clear than what she's saying. Yeah, I think the Canada is just like the mix, you know, undergoing the laws of the neighbor. Yeah, I'm personally not reading too much in those Roger comments. Let's see.
Yeah, I mean, I wasn't been expecting dollar CAD to go to 135 on those sort of comments, but if the US is about to enter some upside in inflation, you know what happens in the US, the Canada usually catches the same cold. So if you're trading a loonie, be on watch that if there is a start to be a pickup in inflation again in the US, that it doesn't spread to Canada, because then they will be forced to unpause and continue on the hike road higher. So just something to keep an eye on there. A bit of data out yesterday in the US, jobs data ahead of today's NFP. Challenger layoffs came in at 77,77, all the sevens, lucky sevens. versus 102,000 prior. Even though it's less than last month, that is still a big number, okay, compared to what we've seen thus far this year. It's been running 20s, 30s, that sort of thing, even less, but we're starting to get some bigger numbers now. A lot of people point out this year-on-year number, huge, 410%. But for me, it's more the case of the actual number rather than the differences over last year. If these numbers continue to be around this level, it is indicating that layoffs are coming in thick and fast among companies. Now, this report, just because that layoffs number is printed, doesn't mean all those people are going to be put out of work. It's an intention to lay off that many staff. So when you hear Amazon announces intentions to lay off X amount of staff, this is the report it appears in. But it doesn't mean all those people get laid off. Some get moved into other jobs, vice versa, so on and so forth. Jobless claims ticked up a little bit. Market again got a bit antsy about this one, ticking up to 211,000. It's not a huge jump. The average 4-week average is up 4,000. Again, nothing major here, but the market is fully focused on jobs at the moment. But we need to keep an eye on it. If it develops into a bit of a trend, then that indicates something different. But no need to get anxious over one jobless claim print, particularly as it's for the first week of March, and the NF has no reflection on the NFPs because that is from the middle of February when that gets counted and reported. But trends is what we watch for in these things. Fed rate expectations have really been doing a dance this week. On Monday, we were pricing 25.50 at 78% to 22%. Right after Powell's first appearance, a 25.50 went to 54%, 46%. On Wednesday, it switched to pricing a 50 over a 25 at 62% versus 38%. And today we've gone the other way again. Now we're pricing a 25 at 54% and a 50 at 46%. It's been the same in Fed Fund futures and other metrics that gauge the probabilities. Futures were pricing near 70% yesterday, a 50 pip hike at the March meeting. Now it's pricing that at 54% with a 25 at 46%. So these rate measures have been all over the shop this week, largely in part to what's happening in yields, and largely what's happening to do with some of the things that are going on in the market, which we'll talk about in a moment. But to go back to or into inflation, there's also been a New York Fed model on inflation, and it's insinuating that inflationary pressures may be more persistent than first thought. They have this thing called the multivariate core trend indicator, mouthful for you, and in January it came out at 4.9%. That was up from December's 4.8%. But what's significant about that 4.8 is that it was revised up from the initial reading of 3.7%. Now, these things, there's tons of these little indicators run by various different Feds, the New York Fed among them. Things like the GDP nowcasts and all that sort of stuff. So you've got to take this thing with a bit of a pinch of salt because everyone's got a different way of counting whatever they want to count. But the market has zeroed in on this, particularly after the PCE data we got last week, and now inflation expectations potentially on looking on the upside. Not that you'd know it looking at yields right now, but that tick up in inflation will play into Fed rate expectations, which even today have taken a bit of a bashing. So what's been driving all the noise the last afternoon and so? Well, it's two things really. The first thing we knew about was the crypto Silvergate Bank situation, problems there due to the fallout from the FTX stuff. So a bank in the crypto sector in trouble. We knew all about that the last couple of days. didn't really have much of an impact yesterday. But then we got this Silicon Valley Bank stuff dropping as well. That's compounded what has happened in markets, because one bank is fine, two banks now gets people panicking a bit. On top of that, we've had, and we spoke about this yesterday, we've had a bit of a confirmation from Biden and his budget. And he's going to be seeking 4.5 trillion in tax increases, which is going to include higher taxes on corps, higher taxes on high income individuals, expanded Medicare taxes on top earners, and higher taxes on US companies' foreign income. Now, some of this budget stuff or these budget plans were touted obviously as part of him becoming president and his party taking power, but it's coming to fruition potentially now. And when you throw that in with what's happening in the banks, if you're a high earner in the US, if you're a big corp with foreign assets and you know you're going to get clobbered, you're going to do something about that. We know full well how that sort of thing happens here in the UK. Anytime taxes are going up on businesses, and there's been a big hoo-ha about raising corporate taxes over here, it has an effect of companies pulling out, reducing investment, so on and so forth. I'm not saying the Biden news is behind everything we've seen going on in yields, but you throw that into the mix with two banks in trouble, and you can see why the market is getting a bit panicky. Now, so what do we know from these banks? Well, we know this Silvergate thing likely to go bust, but on the Silicon Valley Bank, if we're to believe what we're being told, it's not a huge deal in terms of the bank itself. It's said already that it's good for all its deposits. What happened was it issued a share sale to plug a bit of a hole, funny enough, for being long on bonds and getting clobbered as the Fed raised rates and yields jumped. But the market's got a little bit untrusting over it, and all it takes is one or a few of the big boys who have money there to pull it out, and you start a bit of a bank run. But what's being said in markets is that it's not a huge deal. Yes, there may be some ripples, but the whole of the US banking sector isn't in trouble because of this one thing. But markets are going to market, and if they want to throw a bit of a paddy, as I said, you've got several things in the pot at the moment, all sounding negative. It's two banks, not one bank. Biden as well, everything else in the mix. NFP's coming up, higher expectations for Fed rates. You know, we were saying yesterday, things are getting towards the extreme side. When they get extreme, the reaction the other way can be just as extreme. So a lot in the mix, and it's going to be added to or taken away from what happens in today's NFP. What are you making all of it, guys? Stel, what are your thoughts on all this?
Well, it's tricky. With the market, you can see what the market's trying to do from yields. So we're seeing the Fed effectively telling us they're going to be higher for longer. In the short term, you're seeing 1 year and 2 year yields going up. Of course, there's some noise, every now and then, but the trend is for them to go higher. And we're seeing 10-year go lower. So the market is basically expecting the Fed to remain on course with their tightening. And Powell himself said yesterday or the day before that quantitative tightening is going well. So the market expects that to continue. But then the effects of all this are probably going to be pretty strong, pretty disastrous for the economy. So that's what the market's expecting. And now what I guess everybody's waiting for is to see when inflation is going to start ticking down, which is going to be the beginning of the end in terms of tightening. But overall, we've been saying it for a while. We've been saying that the most likely route is for yields to be going higher. Of course, we are now, as I said before, we're seeing a curve move. So we're seeing 1 year, 2 year, 3 year yields going higher, and then 10-year going lower. And the associated move with that is risk going lower. And we saw that in a pretty big way yesterday. And I think that it will remain the most probable path going forward. Having said all that, if we do see a bad number today, a low number in payrolls, that's going to give a support to risk assets, and eventually everybody I think knows that if you buy stocks, you buy any kind of risk asset, you close your eyes, open them in 5-10 years time, it's going to be higher. That's the effect of inflation. If you look at if you go far back in any equity index, 10, 20, 30 years back, we are quite a bit higher, actually a lot higher. So that's the thing, everybody wants to buy the dip, because at the end of the day, if you're a long-term investor, it's the right thing to do, but how far down will the dip go? So, I don't, obviously I don't want to look 5 and 10 years forward. We were trading the markets today, and the market's on knife edge. We are trying to understand when the turning point is coming, and the market's been trying to anticipate that for a while, and it's getting burnt every time. So it's a tricky one. I don't think we're there yet. So for me, the path of least resistance again is for to go lower in risk, because I think a surprise on the positive side is going to have a bigger effect than a surprise on the negative side in terms of payrolls today. I still think the big number, the most important number, is going to be CPI, and that's coming up. Is it next week? It is next week, isn't it?
Yeah, I think so. I think next Wednesday or Thursday, I think.
And there's more and more people talking about the mathematics behind it, and how it's now a 12-month sample instead of a 24-month. So every time a month of high inflation drops out and gets replaced by a month of low inflation, which is what we're going to be seeing now, the effect on the 12-month rate, a 12-month aggregate year on year, is a lot bigger than if it was a 24-month. It kind of makes sense, right? So I'm seeing more people talk about that. We've been talking about that. I've been saying for a while that end of Q1 2023 we're going to start seeing this, and I thought we would probably start seeing an effect last month. We didn't. I think it's coming. So that for me is the big one. For me, that's a big number. That once that starts to turn, and by turning I mean to accelerate lower, then that's going to be game over for the Fed. They're going to be very quick, I think, to pause. And even though they've told us over and over, look, we'd rather over hike and over tighten than under tighten. But I think they're going to be very careful. And as soon as inflation starts to look like it really coming towards target, I know we're a mile away now, but as soon as it looks like it's coming, they're going to put on the brakes, I think, because they just do not want to see the economy get completely crushed. And it will, it will. If they stay higher for longer, every time the Fed does that, every time the economy suffers after that, it's economics 101.
Yeah. So Kate, I mean, taking out the NFP risk, looking at the bigger picture, the broader picture, the market was really ramping up Fed expectations. Is this panic that we're seeing today, is that going to put a little bit of a ceiling up here now, because the market's taken a little bit of a slap on this, had a quick shuffle of the pack? Is it going to stop the market from getting as extreme hawkish as it was, a couple of days ago?
Well, I mean, there's probably like with anything in the market, a double-edged cutting knife, right, or sword. I think yesterday was a bit of a panic move to get me out of there. When venture capitalists and private equity people start to panic, then the whole market needs to panic, because they move around a lot of money. So that is one thing. But then if you take it in the bigger picture, let's assume that this SVB and what's the other one, Silvergate Bank is a storm, yes, but in the end in a glass of water. Well, then you really have to look at the data, and the data will tell us where the yields are going to go, I guess. So you cannot take today's NFP out of the equation, because in the global scheme of things, that is one huge domino that hasn't fallen yet. And if that would fall, then this thing yesterday is just the start off. Then the market is going to reprice Fed funds lower to come. So yeah, CPI is one thing, but I think the jobs market is going to be the other big one where the Fed is going to pay very close attention to. Which is a bit surprising, by the way, today, that nobody is expecting a weak one after the bumper numbers last month. But of course, we can have revisions. But that aside, so what happened yesterday could be a one-off, in which case we are going to stabilize likely again around this 5-10% or so. You have to know that the market does not necessarily have to go to the final target rate, because that is a very short-term rate. It's not a 2-year, right? Actually, the 1-year should be more reflective of or the 6 months or the 3 months or whatever. Yeah, those futures that Stelios is showing, right? Those 30-day Fed futures, those are the ones who should really be reflecting the closest to the final rate. So if they continue to tighten in the global scheme of things, then I reckon the market is going to start to price more of the sort of this kind of risk events that we have had yesterday, because we are now seeing that higher yields are starting to have their effect. So I'd be in doubt that stuff like the 2 years, for instance, is going to go all the way up to 6%, even if they move up to 5.75%, 6%, if the job market keeps up. And if they go further to try and really kill inflation, I doubt that we are going to go that far, but we will be going back into perhaps the 5.25%, 5.30%, or whatever. So yeah, I was thinking about that actually on the yield stuff and on the inversion stuff yesterday as well, and I've got the impression that the longer term market is relatively happy to keep the longer end at or around 4% right now, because that's where they expect inflation to kind of stabilize, and the effect of the continuous rate hikes kicking in. So I doubt that what US 10s can go to 4.25% or even 4.5%. Why not? Those older levels when the market really priced in a lot over the course of the hiking cycle. But I'm not sure whether we have a lot further to go right now, and that even not taking into account yesterday's events, but only taking it as a little bit of a warning sign that stuff may happen, and the impact of the hikes is actually happening now. And I'm not saying we're going to have bankruptcies and more stuff like that, especially not in the bigger companies, because they are usually and they have had tighter rules and stuff. But in the more smaller and medium companies, banks, financial institutions, we may start to see the effect, you know. So I think it's going to be tough for the yields now to price in the full effect, the full length of a possible Fed hikes or the target rate. That's my kind of feeling that I'm having right now.
Yeah, no, I agree with you. There's a bit of a trade-off going on between the risk side of the trade and the rate expectation side of the trade. But you have to say, you know, regulators, the banking industry, governments have just spent the last decade and a half trying to straighten up banking so that these risk events aren't contagious. It's just a question of whether you believe everything they've done over the last 15 years is going to be worth anything and do the job. And yeah, I think in this case, this is probably a little bit of a storm in a teacup. that can still mean big moves in markets as we've seen today. And we as little retail traders, just leaves floating in the ocean, we have to deal with it, unfortunately, and that volatility. But I agree. I think that the market before yesterday, today, was sailing happy with Fed expectations. The risk side of the traders given those a bit of a knock. It hasn't put them out the game. I don't even think a bad NFP data will be too much of a change or change the mind of what the Fed will do. It'll probably cement a 25 pip over a 50 pip hike, definitely. But I don't think it changes the path of the Fed. So we'll look at what's coming for the data, because given what we had last month, that big 517,000, and the fact that there was revisions, counting changes, and all sorts of things. This 205k, if it comes out like that, that's going to keep the jobs market looking strong. That will confirm that this isn't an outlier number, and it was something bad. It's going to say, yeah, the jobs market is still strong. So there's a few things we have to look at. Firstly, if there's a big revision to this number and what that revision is. If it gets revised down to 400,000, no harm, no foul. If it's anything much worse, then that might put some jitters in. But also, let's say we get a negative number today. Let's say we get a minus. What the market is likely to do in the first instance is average out the 2 months. So if it's minus 100,000 here, that would make, both Jan and Feb 400 odd thousand. Split that between average, that's 200,000 a month. That's give or take what we've been running at, the last 6, 7, 8, 9 months. So the market will probably shrug that off. If it comes in something worse, let's say it's 200,000 miss, so it's down 200,000. That makes this number now 317,000. That makes the average, 160,000 per month. That's a bit softer than we've been seeing recently. So I think you've got to take it as a scout. If the number is bad, I'm just talking one side of the boat here. So if the number is bad, look at the average of 2 months. Obviously factoring any revisions into that too, but look at the average of 2 months and compare that to the trend. If we're not too far out the trend, it's not a big deal. If we are out of the trend or moving out of the trend in a significant way, then that's maybe something you need to look at, because that would suggest maybe the domino is at least wobbling. But conversely, on the upside, any plus number, as expected, even higher. If we get another 500, it's going to keep the Fed where they're at. And it doesn't mean they're going to start jumping expectations to 6, 7% for rates. It will keep them where they're at. The market is likely to undo a lot of what we've seen going on since yesterday afternoon, particularly in yields. So we should see yields rallying back up. Dollar will be rallying back up. But I think where we close tonight is going to be important. If we close above these highs in something like the 1 year yield, dollar yen's well above 137, then we're back on the bandwagon. We're going to get expectant for 50 BPs in March, and everything we've seen over the last day and a half will be washed out. If we don't close at higher levels, that's going to suggest the market is going to be roundabout priced on what it thinks is going to happen at the FOMC in March, or a couple of weeks. And then we move to the next piece of data, which will be the CPI next week. So that's my thoughts for the NFP. Obviously, then you need to look at some of the other numbers. Obviously, the unemployment rate is going to be big, but you have to match that off with a participation rate, because the unemployment rate can move depending on the participation rate going up or down. More people coming in and actively looking for work or leaving. So look at the unemployment rate and the participation rate. Then obviously look at wages as well. That number there, 4.7% year on year. If that dips, that's going to take some inflationary pressure out of the trade as well. So as always, there's different components to look at. You look at the headline, we know what to do with the headline, then look at the other components to see if they outweigh what the headline's done. We've also got CAD jobs, so double bubble for if you're trading the loonie, so always one to keep an eye on. The main driver will be this US report, I think, though. But sometimes the CAD jobs can give you a little bit of a counter. If NFP is strong and CAD data is strong as well, and you see a dip in dollar CAD, you know, it's likely that that's a dip that's going to get hit because the US data will trump the CAD data. So sometimes you can find these little trades in amongst everything else going on. So that's covering the NFP. As we know, it's a complete lottery. For all the which ways we can call it, if this is this and that is that, we just sit here, wait for the clock to tick, and then a number will pop up and we all go mad. That's why we love this number, and it's the best number of the month. Certainly when I was on the live floor, you couldn't breathe in the pits. You were literally elbow to elbow, complete silence, 10 seconds before the number, and then bosh, it all kicked off. All fun and games. So let's look at some of the pricing going on. Dollar yen, as we looked at just quickly, not a lot going on really. We're bouncing, give or take, this 136, 137s for now. Again, the marker's going to be where we close on this one. We've got the high print up near the 138s. That's your marker for the top side. Give or take, we're 110 pips away from that. That might be a good stretch point on a good number. Yields will be the driver of that. To the downside, we know that 135, 2030 is a decent level. Again, it's a decent amount of pips away that it could be a possible stretch point. So those are the types of levels I'll be looking at for this one. And dollar CAD, as we've been mentioning, probably need to go into a bit of a bigger chart here. Could be that we're on our way to the 140s. Certainly, we've got a bit of resistance up here at this 138, 60s, 70s area, just below the 139s. If we get above that, then 140 is going to be a big psychological target for this one. It is one that always has a say in things when we get up there at that 140. Anything above there, well, then we may be talking about some of these big double tops up here, these multi-year numbers. But that's a long way away for today, I feel. Looking at some of the others, Aussie dollar still looking weak again. You know, we were mentioning yesterday and in the other shows that the bounces looked particularly weak. You know, these ones up above 66s. You know, just nicking that low, making just a new low today. It keeps it on the weak side. If you want to see a bottom develop, you need to see the former low holding. You know, something like that there, where it comes down, doesn't quite get to that low. So when you get a new low in that, as I say, it doesn't give any indication that this trend is over and that there's no more downside to come. It just weakens the support down here and tells you that sellers are still prepared to push. Doesn't mean we can't find a bottom here, but when you look at things in the now, price action, minute by minute, it just suggests that maybe we're in for some further downside. But as always, you look at what's happening, and 66 is now the resistance area. So despite the bounces that we got before, now we can't get above 66. As I say, keeps the downside pressure on. Maybe we get a look down to my next zone, down around that 61.8 fib down there. Kay, do you want to take a little look around? Or I don't know if Stel's got anything.
I can do that. I'll do that.
Oh, Stel's coming in. We are blessed.
Helios is the one who is going to show what he's got today, yeah?
I'll show my stuff.
I'm on holiday.
Okay, let me grab the screen. Hold on, share screen. Okay. So, we've talked about yields and you know, the 10-year is still, in my opinion, in breakout mode. Yes, we're coming back a little bit, and yes, it's you know, the 10-year is a lot more influenced by flow than fundamentals, and not fundamentals, but market rate expectations. So we're dropping a little bit. We did hold the 10-year on this 38.2 retracement actually to the almost to the pip, which was, sometimes technicals do work. But if you look at the 1 year, I mean, that's just a straight line. Yes, we're down a little bit, but this is a blip. So, and the 2 year, a similar story. So the market is still looking for higher for longer. It's actually slowly buying the Fed's view. It used to completely ignore it up until a couple of months ago, let's say. But now the market's buying it, and Powell is getting his message through. So what do I think for today? Again, I'm not going to bet on the number. I'm not going to guess the number, because it could really be anything. I mean, last number is 500 odd print is proof of that. But in my opinion, it is a market moving number, but the most important one is still the CPI, because really that's what's going to drive the Fed to change its course, and not employment, because employment, I think we can all agree, has been very robust. Yes, you can talk about quality dropping, deteriorating, but the actual unemployment rate is still very low. So it's not employment which is the problem, it's inflation, and that's what the Fed has been trying to fight. 10-year, I still think the risk is for rates to be going a little bit higher. I still think these highs here may be tested eventually, and the risk for equities is to go lower. I mean, I still believe that, and it makes a lot of sense. Sometimes it's a danger that it makes a lot of sense, because the market tends to lean on it in the same way. But look at the S&P. It was fighting with the 50 and the 200 DMA, and it's now bouncing off this trend line. It's it's an important support here. It's a nice round number as well. If we do get a strong number today, this is going to we're going straight to 3,800, maybe not in a straight line, but we're going there. It's I think it's almost unavoidable. And I will reiterate what I've been saying for over a year, I think now. I think the ultimate level is pre-COVID highs. So somewhere around 3,400, if we get there, is where I think the Fed is going to say, right, that's it. We're cutting, we're doing QE, we're going to do whatever it takes, as was it Draghi who said whatever it takes? Yes, it was. Excuse me. And I think that's where it's really game over. And, if you scroll out on this chart, this is a nice little correction. If we get down there, and that's it, we start towards all new all-time highs and beyond. But let's take it a day at a time. And with the payrolls today, the dollar is still on an uptrend. So this is an uptrend. I mean, I still think it's corrective. I think it's going to be, we're going to have one final push in yields and risk, and the dollar goes with that. So I think the dollar is going to squeeze a little bit higher. Maybe, this this 50 DMA with 200 DMA with the fib together, will that be enough? I don't know, but we could easily get to the 50% fib retracement. But I think this move that we are carving out now is a terminal one, and I think it could be that CPI could be this month, could be the trigger for the end of this move. But for now, I still think for today the risk is for a bigger move on a strong number than the opposite. And I think that we could easily take out the highs in the dollar if we do see, excuse me, a strong number. The euro is obviously the opposite of a DXY, the euro dollar being 50% of that. So, I'm not going to dwell on that. It's a similar story, only inverted. The pound, I still think we're done with the upside. If you remember, I changed my bias from bullish to neutral now when we were in the 89s. I still think it's, this move has run its course, and I don't have a bias on that. I will be looking to sell if we do get anywhere near the 90 level, but at the moment I'm just observing. Obviously, the big mover has been cryptos, and on the back of Silvergate and SVB and all that stuff. And Bitcoin is actually playing with the 200 DMA, and this is the last real support, in my opinion, before we get down to the 16,000 level, which is then the really, really big one. Because I mean, if you scroll back, now this is some kind of, oops, sorry, undo. You know, this is some kind of complex, well, not complex, but lengthy sideways consolidation. And it's, we said it before, it's either going to get broken to above 25.3 or, you know, 15.5. And I know it's a big range, but, you know, if you want to range trade it, those are your two levels. And, you know, if either of those breaks, I'm going to step in for a quick smash and grab trade. And I'm happy that there are now futures to trade this, because as I've said so many times, I don't want to get into the logistics of actually, you know, opening accounts and this and that. I want to do easy trades. So this is a nice way to play that. Ethereum is actually broken below the 200 DMA. I tweeted about that. This is a wedge that's getting resolved. I think, unfortunately for bulls, I think it's going to get resolved to the downside. And yeah, cryptos are underperforming in a pretty big way over the past couple of days. Metals surprisingly well, doing surprisingly well. Yeah, I mean, if risk goes lower, you can bet that metals are going to follow. It's going to be a very peculiar environment. You know, we saw that in 2008 after the initial move, where we saw gold just completely spike. You know, there are occasions where risk is getting sold everywhere except metals. I don't think we're at that kind of environment at the moment. So I still think that they're vulnerable to move lower. As equities move lower, the dollar moves higher and the yields move higher. As I've said this so many times, I think this is a weird reaction. It's a knee-jerk reaction the markets always have, but then eventually they see the light. And you know, this is an interesting thing. If you go back to 2008, remember all that stuff happening, you know, all the craziness, and then gold went from, you know, initially there's a drop and then it goes from 700 to, you know, three times that almost within a year or two, which is crazy. I still think the next move is going to be a move like that, but initially we're going to get a downward move, maybe a capitulation move, get the weak longs out of the way, and then just pile higher. Silver has been trading a lot more, well, a lot worse than gold. The gold silver ratio is now 91.5, so trading a lot worse. And frankly, it is a much better you know, proxy to risk than gold, because of its industrial use, and you know, less demand means less demand for physical, even though, you know, there's projection for this year. Last year there was a deficit, projection for this year is the same. So theoretically, all else unchanged, this should be, you know, supply and demand should be pushing this higher, but obviously the dollar strengthening puts on the brakes. This was a very, very strong impulsive move in the COVID era. Are we past the COVID era? I think we are past the COVID era, and now a very, very prolonged, what I think is a corrective move lower. Obviously, it's a big move from the highs, right? It's you know, 30% from the highs. This is going to play out a bit. I think these support at, you know, 18, 19.5 bucks is going to hold unless we get a complete disaster in the markets. And this is the level where I'm looking to get full position long again, and expecting a breakout higher above this channel. And when that does, I think that 30 level is going to be a very, very quick target, and then we see. But this all takes patience, and the way I traded is zero leverage, long time horizon, and you know, lots of prayers. Anyway, what else can we look at? Oil is a very, very tricky one. We are at a level of interest, a range of interest here, and look, we are kind of you know, consolidating and kind of, you know, trying to figure out where we're going next. I still think resolutions to the upside, or even though this is, you know, if Steve saw this chart, he would say, oh yeah, you know, impulsive move lower, correction, down. This will correct lower only if there is a very, very big, move down to the downside in risk. Of course, it can happen, but look, we're close. So I wouldn't go long. I wouldn't actually. If you want, it's probably not a bad idea to take a long here, but you have to be very diligent with the stops below. Do not let that run, because if this breaks, then the target is probably somewhere, I don't know, 65, something like that. So you have a big gap below. So be very careful with that. Yeah.
Don't we have an SPR bidding there, Stelios, that is going to bail us all out if oil goes a little bit lower, because everybody expects them to be anywhere between 65 and 72 bucks. So we should just close our eyes, right?
Well, Biden's going to be buying at below. Is that it?
BTFD, and then all got stopped out at 62 bucks.
Yeah. Yeah, I don't know. It's oil is very tricky. Any
think
market,
it's very tricky. To
any
be honest,
market,
it's very tricky right now because of geopolitics.
Yes, it's not only that, but any market that has a very, very big player who can influence it, which is OPEC. It's like trading the Swissy, and you have the S&P behind. You're at their mercy, basically.
But that's under the global umbrella these days of geopolitics, right? Because you've got some very highly implicated political persons pushing and pulling in OPEC.
Yeah,
and the rest, of course. I mean, and if China sputters, oil will have a tough time to go much higher. Of course, if they reopen and it's everything going better, that thing should be trading higher again.
Yeah, I agree. I mean, China reopening theoretically should be a very nice positive for oil, but there's so much uncertainty.
Yeah, the market has been a little bit shocked about their very conservative GDP target, right?
Yeah.
Yeah.
Yeah. Well, let's see.
I love how they call 5% conservative when everyone else in the globe is going to be lucky to get 0.5% this year.
Exactly. Yeah. Well, it is what they say. What they say it is, right? What they tell us it is. So anyway, yeah. That's it from me, really. I don't have anything else of interest. Let's see NFPs, but really CPI for me is the big one. It's the big one.
Yeah, well, they're all big until the next one. Kay, just before you grab it, mate, I just want to answer.
No, I mean you can all have it. I mean,
question. Yeah, okay. So Stylianos asked or said.
It's another Stelios, by the way. It's another Stelios. Yeah. Hi, Stel.
You lost me when you said that US jobless claims weren't a significant upside print. You can't say that when only one forecaster left over 211K, and while continuous jobless claims had an extraordinary higher print. Right. Well, let's look at it. Here's the trend in jobless claims. This is the 4-week average. There is nothing there, in my opinion, to suggest that there's.
We don't see your screen, right?
You don't see the screen yet?
Yeah, we don't.
Oh, I'm sharing it. Why is that not happening? Let me stop and let me try it again. How's that?
Nope.
Nope.
It says I started screen sharing, but it doesn't show it.
Let me try it again.
Interesting.
Oh. Share. I can see it in the little tab. Can you see it now?
No.
Oh, I don't know what's going on now. I can see it in that little preview tab. It's
happened before. How did we solve it last time?
No idea. I think it was the end of the show, so we said goodbye and disappeared. Oh, anyway, to make my point, I was showing the chart on the jobless claims, and there's nothing there flagging that this number puts the jobless claims into any sort of dangerous territory. That's the point I was trying to make. And if you look at continued jobless claims, and you can all access this chart on investing, you can see that even though it is showing a bit of a tick up, we're still running at pre-COVID levels, down at 1.6, 1.7 million for continuing claims. So you got to remember that it's a weekly number. It can come in. It can go back to being sub 200K next week, and no one's going to bat an eyelid. I think just the market, because it's a jobs week this week with NFP. There we go. Kay's got it. So nothing there to me that signals anything that we should be worried about from the jobless claims data initially. And look, he's doing it all now. Look at that. See, there we go. Continued claims. Again, yeah, they may have ticked up from the middle of last year, but if you go to that 5-year number again, you can see back before the COVID stuff, we're running at the same levels we were when everyone was saying this is the strongest jobs market in decades. So it could all change. That's for sure. But for now, these weekly numbers are not flagging anything, in my opinion. Listen, if it was a good trade for you, that's all that counts. If you had a good trade on it, then happy days, mate. And that's all that matters for that. I don't know what to do now. I can't share the screens.
It's okay. It's time, right? Anyway,
let me stop sharing, and then you try it again, okay?
Okay.
Right, go for it.
I'm going for it. Let's go for it. Entire screen. That one. That one.
No.
Anything?
No.
No. Cobblers to it.
That's your cue to call it a day.
Yeah. Anytime something goes wrong, we blame Steve. Right. So anyway, that was pretty much at the end of what I was going to say. Don't forget our NFP competition. If you haven't entered it, I'll see if I can get the tweet unless that goes wrong as well. But do take care over this number, okay? It is going to be a big one because of everything that's gone on before it, because of anything that happened last month. So watch the number. You don't have to trade it. Let the details come out. Assess the details. Obviously, even our chat room, we'll be all over that like a rash, what it actually means and picking through the numbers. Oh, what a week. And we all get to do it again next week. So thank you very much for coming to the Flow Show and all your support that you give us here within. Thank you, as always, to my colleagues, Stel and K-Man, and to all the FA team for enabling us to put these shows and things on. Guys, take a bow. That was them bowing. Thank you, guys. leave me hanging.
Thank you, Ryan, for being the being a great host as always, and your coverage is absolutely fantastic.
Oh, thank you, mate. You make me blush. You make me blush.
Have a great weekend, everybody. Trade safely.
Yeah, cheers, Kate. Have a great weekend, everybody. See you on Monday.